Hi everyone, I'm Miles. A core question in finance is, are markets truly efficient? If they are, why do people still try to beat the market? Today, we'll use a case and a chart to dive into a core theory, the efficient market hypothesis, or EMH. EMH has three forms, and they're nested within each other. In the weak form, prices reflect past info, so technical analysis can't consistently yield alpha. In semi-strong, prices reflect all public info, so neither technical nor fundamental analysis can beat the market. In the strong form, prices reflect all info, including insider info, so no strategy can consistently earn alpha. The requirements get stricter as you go down. If the strong form holds, the other two must also hold. So how do we test this? A key tool is CAR, or a cumulative abnormal return. It asks one question: are there returns that shouldn't exist? But the key is, we focus on economic significance, not minor fluctuations. Now let's look at a classic event study case. We'll ask one question: is the market efficient across these three periods? And why? First, from t equals -10 to -2, CAR drops slightly, but only by about -1%. This is tiny and likely offset by noise or costs. The core judgment: no consistent arbitrage. Conclusion: weak and semi-strong EMH hold, but strong form doesn't, as no sustainable arbitrage means an efficient market. Why doesn't the strong form hold? Because we can't prove no one's profiting from insider info, which is almost impossible in reality. Second period, t equals -1 to +live. Crucially, at t equals 0, CAR jumps once. The price adjusts instantly with no subsequent drift. Conclusion: semi-strong EM holds, weak form is included and holds, but strong form does not. Why? Semi-strong requires public info to be reflected quickly, which is met, but strong form says insider info shouldn't yield returns, yet the price only jumps at t equals 0. This shows the info wasn't fully reflected before them. If someone knew ahead of time, they could profit, so the strong form is broken. Third period, t equals +1 to +10. CAR is flat with no further abnormal returns. Conclusion: weak and semi-strong EMH hold, but strong form does not. Since there's no trend, weak form holds. With delayed reaction, semi-strong holds. Strong form was already disproven. In a strictly defined global framework, once violated, it doesn't become valid again. Finally, market efficiency isn't about price swings, but whether those swings can be systematically exploited to yield a positive CAR. If they can't, then the market is efficient at the level you can access.